There are 9 ways to fail for every one way there is to succeed. It is much more valuable to see a pattern of success than to see a pattern of failure.
I'm your host, Sam Shaw, and today I'm joined by Steve Dewald. Steve started his journey in investment banking at Deutsche Bank, but one of the most pivotal chapters came when he joined Square as the company's first finance hire, helping scale it from an early stage startup into a global public company with billions of dollars in revenue. He later led marketing and analytics at Caviar, which was acquired by Square. He also operated a family office, and today he serves as the CFO of Outgo, which is a modern financial platform for freight carriers. How did you know that was the right time to sell?
We had created some IP assets that were valuable to one of our competitors, so they were willing to buy it, but it wasn't like a great outcome or anything.
How did you go from being an investment banker to being the CTO? And also, how did you convince people that you could do something that wasn't on your resume?
Well, I started a company with someone I worked with at banking, so that helps. Another analyst at Deutsche Bank. We both left and started a company together. I don't put that on my LinkedIn or resume or anything, mostly because it was a failure.
Knowing what you know now, what would you tell your 18-year-old self today?
I think the most valuable thing you can do at a young age is...
Welcome to another episode of Wall Street Diaries, a podcast about extraordinary individuals who launch their careers on Wall Street and use that experience as a springboard to build world-class careers. We bring you the stories of people who turned that foundation into something remarkable. I'm your host, Sam Shaw, and today I'm joined by Steve Dewald, someone whose career has spanned investment banking, entrepreneurship, high-growth startups, and finance leadership at some of the most exciting companies in tech. Steve started his journey in investment banking at Deutsche Bank, where he specialized in M&A for healthcare technology. From there, he went on to become a repeat founder, launching multiple ventures, including one that was backed by Y Combinator and acquired less than a year later. But one of the most pivotal chapters came when he joined Square as the company's first finance hire, helping scale it from an early stage startup into a global public company with billions of dollars in revenue. He later led marketing and analytics at Caviar, which was acquired by Square. He also operated a family office, and today he serves as the CFO of Outgo, which is a modern financial platform for freight carriers that was also recently acquired. So this is a conversation about taking big swings, building from zero, and using your time on Wall Street as a launch pad to do something truly unique. So with that said, Steve, I want to thank you for taking the time to be here with us today. And it's been a while since we caught up, and I am super honored to have you on the podcast.
Thanks, Sam. It's my pleasure. That was quite an intro. I hope I live up to the hype and have some good stories for y'all.
It's quite the career you've had. And so let's start from the beginning. As I mentioned earlier, you started your career in investment banking at Deutsche Bank, like myself, actually, but you were a year ahead of me. So you graduated from Indiana University back in 2007. Now, a lot of people who want to go into investment banking know about the investment banking workshop at IU, which is very famous. And I remember that you were in one of the very first cohorts of the investment banking workshops. I'm curious, what was it like to be in the IBW back then? Can you talk about your experience a little bit and kind of what that was able to do for you?
Yeah, totally. It was a really special experience. And to be honest, I think I owe so much of my career to the workshop and Professor David Haberly. It's the person who started the workshop. He's actually a VC by trade, not a teacher full-time. So I think he maybe had a really good sense for what is needed to succeed professionally. But I feel like some context is really important. So back in the bulge bracket investment banks were generally not recruiting from non-Ivy League schools, right? If you weren't at Harvard or Stanford or Yale, they wouldn't talk to you, right? It wasn't like you have to reach out to them. It was like you can't even get an interview. And so the investment banking workshop was a really special thing because it gave us an opportunity that we wouldn't have had otherwise. And that opportunity was not because of some connection. It was earned through skills that they taught us. The primary skill they taught us was networking, which might not be obvious because if you guys are aware, so much of the workshop is learning investment banking, right? Like we build M&A models and, there's a very intensive program. But I think the real skill that it taught was networking. I said it was started by Professor David Haberly. He wanted to improve the caliber of the business school at IU, and he was looking at how they do rankings. And the primary metric that contributed to business school rankings was the average compensation for graduates. And so he said, okay, well, what is the highest compensating job for graduates? Investment banking. So he started networking with investment bankers on Wall Street. And there weren't many, but there were some people who were IU alumni that made it to senior positions. Tom Cole at Deutsche Bank was one of them. He was the head of the leveraged finance group. There were a number of others. So Professor Haberly pitched them on this idea, this program. And essentially what it was is he handpicked what he thought were the best caliber people for these jobs. And he personally trained them. And his deal with them was, I'm going to do this for you so that you guys can get this job, but you have to do it for the next class. And that was the deal for every class. So I was actually the third cohort. The first cohort, I think, was 3 people got bulge bracket investment banking jobs. The second cohort was like maybe 7. And by my cohort, it was kind of crazy because the analysts that these banks had recruited were so outstanding that the banks actually wanted to recruit from IBW by the time I was there. And it's because, these kids, they wouldn't have had this opportunity otherwise. So everyone had a chip on their shoulder. They were, studying banking as much as they could, practicing building a model. We probably spent 40 to 60 hours a week preparing for interviews and preparing for the job. Like it was a priority over school. It also gets you accustomed to investment banking hours too. Yeah, so it was a really special experience. I'm happy to go into more detail on any part of it, but I think the real long and short was it taught you life skills and taught you how to get a job. And I think I credit it with everything I am today.
Yeah. No, that's amazing. And I think these days it's a lot more common. Like a lot of especially the target schools across the country now have similar clubs like this. Maybe not to like the level of involvement that you're describing, like 40 to 60 hours and whatnot. But I feel like you guys kind of started a movement there in terms of, the type of prep and resources that could be made available through an on-campus organization. Like it really set the bar for that. So that's really awesome. And it's crazy because I work with kids from IU now on a regular basis. There's so many students from IU who want to do investment banking. And it's like part of the reason why they decided to go to IU is because they heard about the IBW. And
That's crazy.
Yeah. And one of my students that goes to IU and is in IBW, he told me like, I think IU maybe has 2,100 or 2,200 students in the freshman class every year. And he said about 1/3 of the freshman class tries to get into IBW, or basically, you guys probably didn't have this back then, but now you have to take this finance class offered by the school first as a freshman. And they use that class as like the filter basically to decide who can even apply. And so you're like graded on a curve. And if you don't get at least like, I don't know, a B plus or something, I don't know what the exact cutoff is, then you don't even get to go through the actual application process. Right. But like one in 3 freshmen actually sign up for that class because they want to apply for this thing. And a lot of them just get weeded out because I think the class is pretty hard, but that's what it's evolved into. So it's like, it's just a complete beast, I guess, of a club at this point in 2025.
I feel like there's a broader opportunity in academia to repeat this model with other professions. Like this whole idea of every year the seniors teach the juniors how to get the jobs, because that process makes you improve every year, right? Like, what your experience was and you feel like you owe something back to the program. Like that's a core part of the culture. And so as you're going through it and you have your own experiences, you think, oh, what really worked well for me? Like one of the things that we do is a super Saturday interview. So the week or two before the banks come on campus to do all the interviews for internships, the seniors will do mock interviews with the juniors. I put mock in quotes because the interviews are exactly what you're going to get on the job. They're very intense. And I remember someone going through an interview question with me, and he was just brutally honest. He was like, there is no way you're going to get this job if you can't answer these questions. And it was kind of a wake up call for me of like, oh, like I need to study interview questions. Like it's not just like building models in Excel. Like I need to know how to write an LBO on a piece of paper, which isn't something I had ever done before. And it's different. Like you have to use round numbers that you can do the math in your head and stuff. And if you haven't practiced it, you're not going to perform well in the interview. So I feel like it really benefited from this concept of you pay it forward. Like you do for the next class what the previous class did for you.
Yeah, absolutely. And I think, because outside of these clubs, unfortunately, the school itself doesn't really equip you with the kind of skills that you need to recruit well. Like you talked about networking skills, for example, like they don't really teach that in school. You don't really know how to do it as a college student. You've never had to do it before. And I think, like, you and I are much older than probably most of the people in our audience, but we're talking about almost 20 years ago at this point when we were in college. And back then, having a club like IBW is like you're way ahead of the curve because like most other people didn't have that level of support. I feel like now, fast forward to 2025, and because I work with so many students, it's almost like it's just normal now. Like every school has some sort of club like this, and I always encourage like all of the students that we work with, they are in some sort of club like this on their campus. They're not all like of the same caliber or quality when it comes to the support that you get, but like you have to join one of these clubs basically if you want to be considered one of the better candidates on campus. And it's just so much more competitive now than what it was back then. I mean, and it's not just with investment banking. I feel like with everything in life that is like those highly sought after, like if you want to get into Ivy League school or if you want to get into investment banking or you want to get into a top MBA program, everything just gets harder and more competitive over time because the bar keeps getting raised. There's more applicants. People are more prepared. There's more resources. Like kids today, the resources they have is so different than what we had back then, right? Like back then, I remember like we were still reading vault guides, which like now would be
I remember the vault guides. Wow.
yeah, and now that would be like super basic, right? And then like I remember back when we were in college, like the 400 questions guide I think had just come out, and it was like this new thing. And if you read that instead of the vault guide, you were like way more prepared than everyone else. And now the 400 question guide is this like table stakes, like everybody knows about it, everyone's reading it, and you have to do more than that, right? So I think that's the other thing is that like as the competition gets tougher and as the world evolves, like I feel like everyone has to evolve and adapt with it. And I don't envy the people who are in college now. Like I always say, like if the version of me 20 years ago, if I had to compete against some of my students now, like I wouldn't have made it, because they know so much more than what I knew back then. Right.
I don't know about that, Sam. I think it's, I mean, there is definitely, actually, let me ask you a question. Do you think this is because banking as a profession is more mature and the applicant pool is getting more mature in their approach? Or is this a function of like the internet and information sharing and information is just more accessible?
I think it's a couple of things. One, the applicant pool has increased significantly over the years. So I don't have data going back to '07 or '08, back when you and I were applying. But for example, for Goldman Sachs, I have data going back to 2014. For summer 2014, which is at this point 11 or 12 recruiting cycles ago, Goldman Sachs had, I think, 53,000 applicants for summer internships. And they took about 2,600 people. Back then, it was a 5% acceptance rate. And for 2025, the most recent number that just came out for summer 2025, they had 360,000 applicants. And they still took around 2,600 people. So now the acceptance rate is like 0.6% or something instead of 5%. Not that 5% is easy, right? But now 0.6% is basically, what is that, like an 80 something percent drop in terms of acceptance rate. So when there's way more applicants, and it's the same thing if you look at Ivy League schools, like the acceptance rate for top colleges used to be, I don't know, 20% or something. And now like if you want to get into Harvard, I think it's like 4%, right? And so just one, like more people want these things. And then the second thing is what you said, which is with the internet, there's just more information available, right? And that keeps evolving too. Like back in the day, like I said, you start with the Vault Guide, then it was like Wall Street Oasis and Breaking in Wall Street and 400 Questions. Then programs like ours, like Wall Street Mastermind, came along, and that became like, the next thing that disrupted like just reading a guide on your own. Right now, you work with a coach, and then now like coaching is becoming really normal. Like I see so many other programs that have popped up in the last 2 or 3 years now doing what we do, and so now I feel like the industry is getting to the point where for the longest time, like people have used college admissions consultants, MBA admissions consultants. Like it's very normal. There's hundreds of those consultants out there. It's an entire industry, right? But when Wall Street Mastermind started 8 years ago, back in 2017, 2018, like people didn't even know what this was. And it was like weird. It was like, what is this coaching program thing? Whereas now it's like we're hitting that point of the adoption curve where if you use a program like this, you're no longer the early adopter. If you use a program like this now, it's like all your friends are using it. Yeah, all your friends are using it. If you don't use it and you're still just memorizing the 400 questions guide or whatever, like you're not going to be the most competitive candidate. Right. And then now we have AI, right? We have ChatGPT. And one of my students, like he even, after we got him a job in Morgan Stanley, he's a computer science major. And then he went and built his own, basically it's like a ChatGPT, but trained specifically for investment banking recruiting. And so there's resources like that you can like do mock interviews with the AI, and you can, so like things will continue to evolve, obviously. But like I said, like everything just gets harder over time. And, who knows what happens to banking jobs. Also, like some people are like, oh, are junior level banking jobs going to go away because now you have AI that can build models and put together PowerPoint presentations and move logos around on a slide. Like a lot of the stuff that analysts used to spend a lot of time doing, like you don't need to do that anymore, right? And so I don't think the jobs are going to go away, but also don't see the number of jobs increasing over time either, right? And so, if the number of jobs do go down because they become more efficient or whatever, then that'll also make things harder as well, right? So I don't know what the answer is, but what I do know is that the acceptance rate keeps going down for all of these industries, and not just banking, but consulting, Ivy League schools, top MBA programs across the board, right? So we'll see what happens. Obviously, like that's out of people's control. What I always tell people is like just control what you can control, which is your preparation and how good of a candidate you make yourself and things of that nature, right?
Yeah, interesting. So you're probably an expert on this, but I'm curious, how has the filtering process from the investment bank side evolved to deal with all of this interest? Like, are they giving harder interviews? How do you select the top 0.5% instead of the top 5%?
Yeah. So the first thing is like they no longer do all of the first round interviews manually, right? So they do this thing called hire views now. It's been around for like at least 5 to 10 years at this point, but it uses AI to analyze basically like they send you the prompt for the first round. They send you like 5 questions, and then you record your answers into a video, and then they'll use like AI to analyze your responses. And supposedly they analyze all these different data points, not just like what you say, but your tonality, your body language, your eye contact. Like, do you
Oh,
actually
wow.
seem right? And then
That
that's like the initial
that's
filter.
very dystopian. So an AI model gives you the first pass.
And then, some firms will say like, oh, we also have humans review it afterwards, but they're not having the humans review every single
Yeah,
applicant because
you
there's
don't
just
have
too many.
time.
Right. And so that is like the initial screening is like, more automated because of that. But a lot of people don't like that because they're not getting any feedback on like why they didn't progress to the next round or why they did or whatever. Right. And then, yes, the actual interview is so like, if you pass that, you go straight to the super day. But for the super day, the questions are also getting harder as well. It's no longer just like walk me through $10 of depreciation order. That's like super easy. And anyone who's read the 400 questions guide will know how to answer it. And everyone has read the 400 questions guide. So they just have to start asking harder questions to be able to like separate the candidates that, are really, really good versus the candidates that are just like above average. Right. And so anyway, I guess that's why programs like ours exist, and so to help people kind of get to that next level, right? And have the type of prep that you're kind of describing with IBW and what they did for you before. It's like not everyone has access to that type of resource, and especially if you go to non-target school, you may not even have a club like that. Or if you do, the quality is definitely not to that level. And then a lot of people now, even if they're in the club, not everyone in the club gets equally good offers either, right? So a lot of students are like, I'm still competing against the other folks who are in the same club as me. And so we'll get, presidents from like the investment banking club at Wharton, which is like you go to the top finance target school already, you're the president of one of the best clubs on campus, and they're still coming to us. But they're not coming to us because they're like worried that they won't get a job. They know they'll get a job, but like getting a job at Goldman Sachs is, not the
Yeah,
same as
there's
getting
there's
a job.
always there's always a more coveted job.
Right.
I
Or
remember
private equity. I'll go straight to Blackstone
I
and
was gonna say back when I was in it, we heard of some kid at Harvard that got a first year private equity analyst job at Blackstone. And that was unheard of, right? Like they had only ever hired out of investment banking. You needed 2 years of banking experience. So to get a job like that out of college was incredible.
yeah, exactly. Anyway, not to spend too much time on this because I want to come back to your story, which I think is more interesting. So
Yeah,
you break into
there one thing I want to say about all this, just to like give everyone a ray of hope. At the end of the day, you're competing with humans, right? And
yes,
like all of these tools that give everyone all this like education and help them prepare and everything. At the end of the day, it's still a process that is meant to identify the people who work hard and are diligent in preparing. And
absolutely.
I think I imagine the degree to which people are working hard hasn't changed. Like there really aren't that many people who are able to work 80 plus hours a week, stay focused, that are super driven. And I'll just give you an example. Like I've been doing a lot of hiring a bunch of finance people. So I've been looking at a lot of resumes. I can look at a resume and in 5 seconds find an error. And that's true for literally 95% of resumes. People have inconsistent spacing or they use M dashes or N dashes or the bullets aren't aligned. Like there's some kind of error. And it literally only takes me 5 seconds. If I
Yep.
find a resume that doesn't have any errors in it, like if I can't find a mistake, a grammatical mistake or a clear formatting mistake in 20 seconds, that person gets an interview. I don't even have to read the resume, right? Like the resume is an example of someone's work product. And you can have all these tools to help you prepare for interviews and stuff. But at the end of the day, like you're competing with people who, if you're putting in the effort, you're going to have an advantage.
Yeah, for sure. Absolutely. I think that's absolutely right. And, it's attention to detail, which, yes, even though the application pool has increased dramatically, a lot of those people, they're not your real competition because they're like not really at the level that you need to be at to actually be considered a serious candidate, right? So
Yeah.
that's the ray of hope. But so coming back to you though, like you go through IBW, you break into investment banking, and then I think you left banking after just over a year, right? So like I guess I'm curious, like what made you walk away from that path after just 1 year? Because usually the analyst program is 2 years, right? And
Yep.
did you ever like second guess that decision? Obviously, your
Nope.
career turned out. So, like, talk to us about kind of what went into that decision, I guess.
Yeah. So it is a 2 year program, sometimes three. And I definitely recommend people do 2 years. I feel like I was an exception, but it's funny saying that out loud. I never was attracted to investment banking as a career. I always wanted to be an entrepreneur, and I saw investment banking as a way to learn business. And
Mm,
this is like you're in college. There's a lot about the world you don't know. You're kind of naive. Frankly, I think banking was the best job I could have gotten out of college. It was great. But 1 year of investment banking told me plenty about finance, and there is a lot more to business that isn't finance. And
yeah.
spending more time there wasn't going to be that productive. It was also the global financial crisis. So markets crashed. This is funny on bonus day. So the way bonuses worked at Deutsche Bank back then, there was like a blocked off time on the calendar and everyone took turns going into the group head's office where like they deliver you an envelope with your bonus. And I remember on bonus day, they had some people go to a different floor and they were kind of confused and we were kind of confused. Like no one really thought anything of it. But like those of us who were on our floor, like we got our bonuses and like everyone's kind of happy. Some people are more happy than others, but getting paid is like a day to celebrate. And the analysts that had gone to the other floor, they came back like 30 minutes later and they were all like teary eyed and they were like, hey, like goodbye, like I'm done. I was let go. They didn't get a bonus.
It's
Yeah. So
brutal.
that
So they
was
waited until like the last minute to cut them and not pay them, basically.
Yeah, they literally let them go on bonus day, about 40% of our analyst class. Yeah, so, I was kind of just looking at this rationally, like, hey, this isn't a career for me. I'm here to get an experience, and it's great experience. I might have considered doing it a second year, but, the experience is kind of tied to the deal flow. And so is the comp. And so I'm faced with the prospect of I'm not sure I'm going to get to work on super interesting deals over the next year because the market's crashed. And by the way, I'm probably not going to get paid as much as I did my first year. Do I really want to stick around for a second year to get paid less? And it's not like I'm going to work any less hard. Like the hours that you work, uh, people will create as much work as you have hours to work. So yeah, I never second guessed it. It just made perfect sense.
Basically, it sounds like you went into banking with a very specific goal in mind, which was you wanted to learn as much as you can about how to think about businesses, how to understand like financial statements and what are the financial drivers that make a successful business. And then once you got what you went for, then basically it was time to move on. And that is really interesting because I don't feel like that's how most people go into banking, or that's not the mindset that most people go into banking with. Or like most people go in and they assume that they want to do 2 years or 3 years. In fact, a lot of people, and myself included, I feel like choose to go into banking because we don't know what else we want to do, and this is just like a good high paying option that allows us to kind of like kick the can down the road and buy ourselves some time to figure out what our calling is or whatever. But I think like for people who do know exactly why they're doing it, that can make a lot of sense as well. You actually remind me of one of my earliest clients. His name is Dean, and he also went to a non-target school. He went to Lehigh, and we helped him get into banking for a summer at Stiefel. But he was also like you, as in like he's always been very entrepreneurial, even going back to college, and he always knew he wanted to be an entrepreneur, and he was kind of just doing banking as like a to collect the experience and learn the things he needed to learn, and he was never planning on staying in banking. So like he actually didn't end up even doing banking for full time, and now he started a Series A tech company, and they just raised like $16.5 million, $50 million valuation, I think like 6 months ago, and it's like great for him, right? Like
Yeah, good for him.
that's a much better outcome than just, staying in banking and grinding away for however many years and, having terrible work-life balance and whatever, right? I mean, not that like what probably works even more now as a Series A founder, to be fair, but like he is like really enjoying it. He loves what he's doing, right? And also like if it ends up working out, like the outcome is going to be significantly greater than whatever he would have done in banking, right?
Yeah,
So
most people don't stay in banking though, right? Like I feel like the program is you do 2 years of banking and then, you have lots of good career opportunities from there, right? Like
absolutely,
if you want to keep doing that kind of work, you could just go into buy side private equity, do the same
right.
work, get paid more, probably work a little bit less.
But not that much less. Yeah, but yeah, probably slightly better. And yeah, absolutely. Like most people leave, which is why like, the guests that we've had on this podcast, they all started in banking, but then they all left and went on to do a bunch of other really interesting things, right? So, and that's also what we kind of want to showcase for our audience too, is like, hey, even if you may not want to be a banker forever, there are a lot of interesting exit opportunities that you can have coming out of banking and lots of different possibilities. So I guess that's a good segue though. Like after banking, right? You
Yeah,
leave.
and sorry, I want to make one comment. It's
Yeah.
funny, like talking about this. I realized that my 1 year of investment banking defined who I am professionally more than anything I've done over the last how many years have I like 20 years that I've been working. Like I think of myself as an investment banker, right? And I only did it for 1 year. The way that I work was influenced more by that 1 year of investment banking than any other professional experience.
Yeah. The things you learn, especially not necessarily just like the financial modeling and things like that, but like the soft skills that you learn and like the work ethic, like learning how to work hard, like that is a skill, right?
It
And
it
like,
is. It's huge, and
yeah,
it's such a competitive advantage in the rest of the world. And you take an investment banker that's been working like, 90, 100 hours, and you put them in corporate America, And they're like working 60 hours is like a breeze, right? Like they have weekends off. They're like making friends. They're going on, dates and living a great life, 60 hours a week. But they are absolutely crushing the competition at work. They're getting promoted faster. They're having more of an impact, everything.
Yeah, that stays with you forever. It's like once you learn those things, you can't really unlearn it. So it just sets such a good foundation for the rest of your career. Like even just having that, like being able to outwork everybody else. I don't care, like, how smart you are or whatever. It's like your floor is significantly higher just because, like, everyone else is, working 40 hours a week and they're getting tired, and you're able to work 60 hours a week with ease. Like that's 50% more than everybody else. Right. So you don't actually even have to be that good to outperform other people. Right. And on top of that, of course, you probably are that good. And so, then the gap is even bigger. I think that's a really good point. But so you leave banking after a year, and I think you took a break for maybe like a year or so. No? Okay. I know, like, because you became the CTO and co-founder of the Y Combinator backed startup. Like,
Yeah.
how did you start doing that right away, or and
Yeah. Yeah.
how did you go from being an investment banker to being the CTO of a startup? Like, that's not on the bingo card for like typical exit op, for an investment banker. And also, like, how did you convince people that you could do something that wasn't on your resume?
Well, I started a company with someone I worked with at banking. So that helps. Another analyst at Deutsche Bank. We both left and started a company together. So that's
Mm,
what I did in the gap year. I don't put that on my LinkedIn or resume or anything.
I see.
Mostly because it was a failure. It's funny. Something I tell people that I think is like really prescient and is sort of like hard advice is everyone learns from failure, right? Like we celebrate
Right.
like, hey, like I failed, but like I learned a lot, right? That's
Yeah.
great. You learn from failure. That's better than not learning from failure. There are 9 ways to fail for every one way there is to succeed. It is much
Mm,
more valuable to see a pattern of success than to see a pattern of failure. If you see a
sure.
pattern of success, you can copy all the things, and maybe you don't know what the secret sauce was, but you copy everything and like it's more likely to work again. You see a pattern of
Sure.
failure, you try and figure out what went wrong and like don't do that, but you don't know what to do. So,
Right.
I think it's important for people to learn from failure, but I don't celebrate failure. I celebrate success.
So you don't give participation trophies?
No,
I'm just
no
kidding.
participation trophies. No. Yeah. So I left banking.
In
I did
case
a
you can't
start.
tell, Steve is a tiger dad, obviously. Just kidding.
A little bit. I'm one of two parents, so it's our parenting style is a negotiation.
Oh, that's so funny.
But yeah, I looked at banking as like, I got my bonus. Oh, hey, fun little story actually. I had a friend in HR who told me that people who quit on bonus day, they had historically reversed, in some cases, they had reversed their bonus. So, like the
Really?
bonus is deposited via ACH into your bank account. A bank
Yeah.
can do an ACH reversal and get the bonus back. And I
Interesting.
was like, and I didn't know much about like how the banking system worked from like a transaction perspective at that time. And so I was like asking like a bank teller, like, well, how long can they reverse the ACH? I was kind of scared. So what I did is I worked on Wall Street. Deutsche Bank was on Wall Street at the time. So I walked down Wall Street. There was a First Republic bank on Wall Street. I walked into First Republic and I opened a bank account. And I went back to my Chase Bank and I withdrew my entire bonus in cash and I put it in a briefcase. And I walked down Wall Street back to First Republic and I deposited my briefcase full of cash into my new bank account.
That's so funny.
Yeah.
Usually having bricks of cash in a suitcase, that's like straight out of a TV show. You're like Narcos or something, you know?
Yeah. It's super crazy. I mean, all the banks around there knew when it was bonus day. So I'm sure they had crazy stories.
That's so funny.
But yeah, so I looked at my 1 year of banking. I was like, hey, I got this bonus and this cash it can pay for rent for a year while I go work on a startup or, maybe then some. And
Mm,
that's what I did. So I just found like the absolute cheapest place that I could rent. And my co-founder at the time did too. And we just didn't do anything but work on our startup for a year, like
wow.
24/7. I didn't see I worked almost banking hours. I slept an appropriate amount, but other than that, it was,
Right.
I didn't. I didn't like go out and see friends. I didn't participate in dating. It was like heads down working for a year.
So you were the technical co-founder, and your fellow analyst from DB is responsible for what?
Yeah, well, I think maybe that's part of why it didn't work out. Since then, I would probably think a little bit more critically about like filling the right roles and partners that you start companies with.
Yeah,
This was like the first real startup as a professional with money. Like it's one thing if
yeah,
you're hacking on an app and, but this was much more serious. And
mhm,
I think in retrospect, the early work of a startup, at least a tech startup, is building a product. And
right,
people who don't have technical skills can't contribute to building the product. So,
right.
um, I think that was part of our challenge.
Gotcha. That makes sense. And so that startup is the one that went through Y Combinator, or was that a different one?
No. So I had wanted to move to Silicon Valley. I don't know why. I just I heard that was the place that people did tech startups, and my co-founder had reasons to want to stay in New York. So we were actually living in I was like renting someone's basement in Long Island. But
Mm,
when it was like clear that things weren't going well and it was time to part ways, I was like I want to go to San Francisco. I didn't have a plan. I didn't know what I was going to do. I knew one guy in San Francisco, actually from the investment banking workshop. He was one of the people in the class ahead of me. So he was in private equity at the time, but he had his own apartment and he was like, Steve, you can sleep on my couch. So I did the cliche thing of, I
wow.
packed a suitcase and I lived on my buddy's couch for 2 months. And my buddy was like, hey, like, I don't want to keep doing private equity. I want to start a company. I heard about this thing called Y Combinator. Let's apply. And so in the 2 months that I was on his couch, we came up with an idea, started working on a prototype, and applied to Y Combinator. It's funny. Y Combinator, very similar to the investment banking workshop or anything else. Like the skills that we learned how to network and get a job applied to Y Combinator as well. So,
Mm,
if you just drop your application in Y Combinator and hope you get a call back, man, like good luck. What we did is we networked our way to everyone we knew in Y Combinator. We were looking on LinkedIn. We were going through a friend group. Do you know anyone? We were looking at all their events and looking at Hacker News and seeing if we were connected to people and just meeting with anyone we could. And the people in the class in front of us, when we met with them and expressed our interest, they were able to put in a recommendation for us. So
yeah.
when we're going in to interview with the YC panel, they already know who we are, which is
Mm,
different than the other, I don't know, like 1,000 applicants that they had at the time or something like that.
yeah. They were still relatively new back then, right? Because this is many years ago, but it sounds like they were already pretty sought after as like an incubator.
I would say they were pretty under the radar. So Y Combinator was actually based in Massachusetts near MIT, I think. They had done 2 seasons of like the Y Combinator program before moving to Mountain View in the Bay Area.
Yeah.
And in Mountain View, I think it was like a game changer for them. Like that's where the startup scene was at the time. And so their first cohort in Mountain View was Dropbox, Airbnb, Roku, Edit. Like there's others in there, but a lot of stars. And at the time, it wasn't obvious that they were stars, but they were definitely making progress. Like they were people that figured out how to raise capital, um and Y Combinator had the same program as the investment banking workshop. The program was that Paul Graham helped. He was a founder, had sold his company. He wasn't in this for the money. He wanted to like help founders. And so he helped these founders figure out how to raise capital, how to launch, do like a press launch, how to a number of different things. And his
Yeah.
thing was, after I help you, you got to help the next class. And so
Right.
he picked for each topic, like fundraising was a topic. He picked the person from his first class that he thought was best at fundraising, and they taught
Mm,
the fundraising segment to our class, which was great, right? As like they were
wow.
probably better at fundraising than Paul was. So yeah, Y
That's
Combinator, absolute great experience. It was really under the radar at the time. I think in our class there were maybe 23 startups. That number's ringing a bell in my head. Paul was great at networking and was able to pull in like really amazing people. Mark Zuckerberg taught a class. So, you're
Wow.
one of like 40 people sitting there, and we always have dinner leading up to the class. So like you're sitting there having dinner with him and like talking about Facebook was like not as big of a deal as it is today, but it was taking off. Like, he was
Yeah.
a little bit of a celebrity in the tech scene. And, he's like, hey, like if you ever decide you want a job instead, like here's my personal email. We had,
Should have taken that
I
job.
think yeah, probably in retrospect. I don't know. Square did okay.
Yeah, that's true.
We had one person who was a really interesting interview. I'm going to tell a story. I've told this story so many times, and like since this is being recorded, someone's going to fact check me. So I hope it's all true. But we had this guy come in. His name was Craig Silverstein. Do you know Craig Silverstein? No?
No.
Okay. I'm pretty sure that's his name. It's been a while, but he came in and he had two bodyguards and an assistant. And it was really weird. And no one knew who this guy was. And he had like a really weird, like rather than a presentation, he was like, I don't have a plan for anything to talk about. I'll just take whatever questions all up front ahead of time. I'm going to put them on the board and I'm going to tell a story, that answers all the questions. And he introduced himself as the founder of Google. Yeah. So this guy founded Google and no one's ever heard of him. And it's a true story. He was in the PhD class with Larry and Sergey, and like he's just kind of under the radar. But he joined Google before they even incorporated a corporate entity. So he's like truly a founder. And anyways, he had a great presentation. It was really interesting hearing him talk. And Y Combinator was a great experience. Like you get to meet all these. Well, at the time, I think now it's probably a little bit diluted because they've scaled up so much. But at the time, like, you're one of a small group of people and you're getting to learn from all of these amazing people. You're getting to learn from the people in the class in front of you. It's great networking too. So, the stars from the previous class, their investors, their VCs are asking them like, who's hot in the next class. And so it's just it's a flywheel.
Yeah. The thing that this makes me think of is just how important it is to find a community of like-minded people who are trying to do similar things as you. And I'm sure just by being surrounded by other founders who are also trying to build these startups and just being immersed in that environment, there's so much you can learn from each other just through sheer osmosis. But also I think like a lot of times, like starting a startup or even like our own community at Wall Street Mastermind, like students are going through banking, recruiting, like whatever it is that you're working towards, like a lot of times it's really hard. Like what you're trying to do is hard and it can be lonely. And a lot of your friends who are not doing that probably don't understand it. And so like to have a group of people who understand what you're going through, and in fact, they're going through the same things that you are, sometimes like that's part of what keeps you going too. And a lot of times half the battle is just like not giving up. Right. And not feeling like you're alone and just even for your own psyche, And so I think like even I myself thinking like going back to college, like you had IBW in college, I had, AK Psi, which is business fraternity. Those like my pledge brothers, the people that I went through recruiting with, like I would not have made it without them,
Do you
And
still
so,
keep up with people?
yeah, I mean, my pledge bros are like my lifelong friends, like we still
That's
meet up
awesome.
to this day. Like we all have kids now. We live across like different cities in the country, but we still meet up, hang out. I just saw one of them last night because she and her husband were visiting New York from the Bay Area, and we went out and got drinks on a Wednesday night. So those relationships too, like that's also super valuable because I don't know, most people don't. You could probably count like the number of people you could consider as lifelong friends on one hand. Like you're lucky if you have many, and a lot of times like joining a community like that because you have that shared experience of going through something really hard together that like bonds you together forever, right?
Yeah, it's interesting too that I imagine this is true for most people, but you just got me thinking about it. Like when I think of my closest friends, they came from really tight-knit communities, right? Like I made those friends while I was experiencing a part of a community. Like, I'm still friends with people from the investment banking workshop, still friends with people from Y Combinator. It's hard for me to think of people that I'm really good friends with that I met outside of a community context.
Yeah, absolutely. And I think the difference is because, you have that shared experience as the foundation and like going through something hard together. I think that is like what really brings you close together in a short amount of time. And because you're also similar, like you're like-minded and you have similar goals, I think that's really huge too. Because I've had different groups of friends over the years, and then like as you change, like you change as a person as you get older, and then your goals evolve, and then maybe like friends from before that has similar interests as you no longer have the same goals, and then you kind of drift apart and you're no longer as close, right? Like that just I've seen that happen so many times just in personal experience. And so nothing wrong with that. It's just like, you evolve, and then you grow, and then some people grow with you and some people don't, right? So I guess in this Y Combinator, like your startup ended up getting acquired, I think in like under a year, right? So that doesn't always happen for most startups, I would say. And so like, what do you think made that possible? And also like, how did you know that was the right time to sell, I guess?
Yeah. I guess, first of all, an acquisition is not necessarily a good outcome.
Mm.
They should give a disclaimer to everyone who tries to start a company. Um, yeah, this acquisition
So,
was nothing.
explain what you mean by that.
Yeah, well, I think I guess let's break it down. Like, this is a technical audience, so you hear that someone sold their company for I don't know, $30 million or something like that, $100 million, a big number. The thing is, that merger agreement is 200 pages long, and you can't summarize 200 pages of complex structure into a single number like $100 million. I'm sorry, you just can't. So it's like, what does that $100 million mean? Like, okay, well, the investors got their money back because they had a preference. So if you raise $30 million, 30 million cash goes to investors. All right, 70 million left over. Well, now you have a team. The team needs to be compensated. So a lot of times these headline numbers include just basic compensation for the team. And sometimes it's not even a good job. So like, your team could go get an investment banking job, making more money. And instead the acquirer is like offering them jobs that are, again, nothing to celebrate. But like that adds up to, $20 million. Okay, so now you have $50 million left over that the common shareholders are going to get. Like you and your co-founders have the majority of that. Well, what does that look like? These companies, like, they're not in the business of just like giving people cash. Sure, there are people that have great outcomes where maybe you get $50 million cash or like stock in a publicly traded company. But a lot of times what you're getting is $50 million of a security interest in the acquirer. So, for
Mm.
example, a private equity acquirer, I've seen a number of friends go through that. A private equity acquirer will give you nominal $50 million. But in order for you to get that $50 million, there has to be a liquidation event. The private equity company has to exit their portfolio investment, and there's a hurdle rate of return. So they tell you it's worth $50 million, but it's kind of like in sales, like you have an accelerator. If you don't hit some minimum amount, it's actually zero. And sure, it's 50 million if you hit the target valuation that they made up when they were pitching you on buying your company. But a lot of times people get into situations where, and then when the private equity company sells, sometimes they're selling to another private equity company. And so it's not even clear if they're hitting the valuation milestones that you need to get your payout. The private equity company could structure the sale in a way where it obfuscates the valuation in order to avoid compensating employees. So there's just like a lot of like, I'm kind of painting the like negative picture, but selling a company should not be construed as a positive event. The best companies don't sell, right? The best companies keep growing.
And just go public and just become publicly traded.
Yeah, or I mean, SpaceX is still private, so
Sure.
there are other options. Stripe is still private.
Yeah.
But yeah, if you think about it, at its core, selling a company, you're selling your ownership in something that you built. Why would you do that? Like, why would you
Mm.
do that if things are going well, right?
Mm.
It just seems to me like if you have an asset that you are willing to trade for cash, which is a commodity, it means like your asset isn't special. Like you're valuing it less than the cash. There are situations where you build something that is so much more valuable to someone else that there's a strategic rationale for them paying you
Yeah.
more than what it's worth to you. generally speaking, like as a founder, you create a company, like it's so much work creating a company, like you pour your life and blood into it, and to like, to sell it for financial outcome, I think a lot of times when people sell, it's not their preferred path. It's, you
Interesting.
struggled to raise capital, which was our story. We got a term sheet for a seed round that just wasn't very attractive, and we kind of felt like it wasn't worth continuing to pursue the company. But we had created some IP assets that were valuable to one of our competitors, so they were willing to buy it, but it
Gotcha.
wasn't like a great outcome or anything.
Not the answer I expected, but a very interesting perspective. And I think you're keeping it like super real with the audience, which I appreciate because you're right. I think in Silicon Valley, especially, or if you're just like reading TechCrunch or whatever, it's like a lot of times it's glamorized in terms of like, oh, like there's an exit, you sold the business, and you're right. Like people just look at the headline numbers, but the devil's in the details. And once you actually look through the waterfall of like who gets paid what and how much you actually got and all the different strings attached to the purchase price, and some of it is equity in your buyer that may or may not pan out themselves, and others are maybe tied up in an earnout and this and that. It's just like it's not always what it seems. And I guess that's just a really good point. And I think only something that someone who has actually gone through that experience would have that perspective, versus like
Yeah, and
most
I'll say this just to kind of disabuse people. If you sell your company and you get equity in the acquirer, like just clean equity, that's probably a good outcome, right? Like a lot of times that's, maybe better than cash even. It is pretty rare to sell a company and just get equity. There are always strings attached. There's structure. It's,
Yeah, I was gonna say it depends on who's buying you, right? If your sales proceeds is in the form of equity, obviously after I worked at Square with you, then I went to GitHub, and obviously GitHub got acquired by Microsoft, and then that was an all equity deal. And I think the exchange or the Microsoft share price back then was around like $100. And so obviously that's worked out pretty well because now they're trading at over $500 many years later. But that's Microsoft, and your acquirer is not always going to be someone like Microsoft, one of the best and most valuable companies that's ever been created, right? So not all equity is created equal, I guess. And
yeah,
if you're
to-
selling the company for equity, you basically have to really believe in the story of whatever that company is, right?
totally. I don't think Microsoft acquiring GitHub is representative of like, the sub $100 million tech exits.
Yeah, for sure.
When
For sure.
once someone's willing to trade $1 billion of value, like even if it's nominal and not really a billion, like the numbers get big enough and you start to like the standard terms start to look a lot different. There's, less structure, more clean equity. If Google buys you for your technology, like they're just paying cash or stock.
Right. For sure. Cool. So I want to pivot a little bit into where I met you, actually. So I met you at Square. You were my first boss there. You were, and actually, even before that, I guess you joined in 2011, and you were the first finance hire at Square. And I think you helped start his finance and strategy team, which to this day, I have to say, I've worked at multiple different places. I still think that was like probably the best team that I've been a part of, and also the most enjoyable
Yeah,
team that
me
I've been
too.
a part of. In terms of like the culture and the caliber of the people I got to work with and learn from, and the camaraderie and the impact we had on the business, there's just a lot of really amazing things and fond memories that I have of the year and a half that the brief 1.5 years that I spent there. Regardless, like at the time when you joined, I believe Square had just raised a new like $27.5 million round from Sequoia. I think it was like a $240 million valuation. So it was still very early days. I don't know what they were. I think the last time I checked their stock price was worth like $80 billion or something, right? So it was like that was 14 years ago. Now, how did you land that opportunity, or how did you come across it? And also, like, what convinced you it was worth the risk? Because obviously hindsight is 2020. Like you can look at it now and be like, oh yeah, of course. So obvious you should have joined Square. But at the time, I don't think that was the case. Right.
Oh yeah. What
So
this is a great question. I have such a great answer for this question. You're gonna love this. But I think first to tell the story of how I got to Square, I have to bridge the gap from Y Combinator. So after we sold the YC company, I started a new company. It's called Proper Suit. We sold made to measure suits. They were produced in China and we sold them to people in the US. At the time, it was kind of a novel concept. Now there's, Indochino and a bunch of other ones. One of the things that I did at Proper Suit was anytime someone in the Bay Area ordered a suit, I'd write them a personal email, introduce myself as CEO of the company, and I would offer to do their fitting personally. They could come to my house or I would go to them. And
Wow.
and I met some really amazing, the kinds of people who were buying suits in San Francisco at the time. Like, you didn't really see people wearing suits. So it was mostly like tech founders that were, felt like they needed a suit for some reason, and VCs. And I had a couple people doing weddings, and actually that's how this happened. So I did a wedding for one guy, and we were doing the fitting, and he was telling me he was like a tech founder, started this company. It was called Squirrel at the time. And he told me what they did. One of the challenges I had at Proper Suit was we'd do these fittings and people would get really excited. They'd want to order a second suit or upgrade something. And I would have to send them an invoice via PayPal, and people had changed their mind. There was definitely like value to being able to take payment at the time someone wanted to purchase something. And so he was telling me about their product, and I was like, wow, this would be really useful for me. And so Proper Suit became a beta merchant for Square, and it was really useful for us. It was a great product. So
You're talking about like the very first dongle?
yeah, one of the first dongles.
Okay.
Yeah. So we don't need to get too much in the story, but Proper Suit's probably the first thing I did that I would consider a success. We got to about $1 million run rate revenue in 8 months. We were profitable. We were throwing off enough cash that, it was like comparable to a job in banking, similar hours. But my partner and I wanted to go in different directions with the company. I wanted to raise venture capital and really try and scale. And he wanted to run it as a lifestyle business. So he agreed to buy me out, and we came up with terms I was happy with. And I didn't know what I was going to do next. I didn't have a plan. And so I was talking to my buddy who was, they had rebranded to Square, and it was obviously very successful. And, I had been using the product. I stayed in touch with this guy, and, we were chatting, and he was like, wait, you don't have any plans? Like, dude, come to our office. Like, we're growing so fast. Like, just come to our office, check it out. And so I came to the office, and man, I don't think I've ever been so impressed by a company in my life. They had this like big open office floor plan, and there were kind of these like I guess cubes. Like, they didn't have the privacy screens, but like, everyone was sitting in these like desk pods, kind of clumped in different areas. And next to each pod, there was a giant TV screen. And this TV screen had real-time metrics for each of the teams. And it was like, these real-time metrics were branded in like Square colors and Square font, and like they were very nicely designed, and they were really useful. So I'm getting a tour of the office, and we're like walking past the like support department. And they have real time an estimate of the support backlog in hours. Like, how many hours is it going to take the support team to like work through this backlog? And it was broken down into like, they need to respond to, 2 hours of tweets, 1 hour of Facebook messages, 6 hours of email or something like that. And there were like other metrics on the screen too. But I remember walking by the support team and just being like, wow, they have a really long backlog. Like, is something wrong? Like, I immediately was able to get a sense for the state of the team from these metrics. And it had turned out that there was like a major PR event. One of Square's major competitors at the time, like, had a tweet storm about Square, and it was like a really big deal. So there was, so the metrics accurately reflected or like the special thing that was going on. And I just thought that was like so awesome. Like, any company that is like that well run and organized, man, like,
Yeah.
I'm interested. So yeah, I got the tour of the office, and then they put me in an interview room. I didn't know I was going to be interviewed. That my buddy was like, yeah, I just need to like meet with some people. And it was totally an interview. So I wasn't too prepared, but I met with someone who was talking about the finance work that they needed. And I guess they had to like interviewed a bunch of other investment banking people. I'm not sure why I like resonated so much with them. like the interview went really well. They were really excited and they told me like, you know, like I'm interested in hiring you, like, and I didn't have anything else going on. So I was like, okay, like, actually, I wanted. Sorry, I'm making this a long story. I wanted to get into VC, so I was planning on interviewing with VCs, but I hadn't set anything up yet. So I told them I would start working as a contractor if they were open to that, and they were like, "Yeah, absolutely. When can you start?" And I was like, "Right now." So it was probably like 4 or 5 p.m. So they were like, "Come back tomorrow morning." So I started the next day. So yeah, that's the story of how I came to Square.
That's crazy. I've never heard that story before, and I worked with you. So okay, you become the first finance hire, and
Well,
like I
technically,
said,
I'm a contractor at this point. So one of your other questions was,
like
sorry,
how did
you
you
cut out for a
start?
second.
Oh no, I was gonna ask like how did you go about building something like the finance and strategy team from scratch? Obviously, it's not something that existed already. There's no playbook for it. I don't think you had built a team like that before, right? And so how did you go about doing that? And like where do you even start, I guess?
Okay, but before we go there, I want to answer a question you asked earlier, which was how did I decide to join Square, like a startup, over other
Right.
opportunities?
Yes.
So I'm working as a contractor and my job is to like do finance, right? So the first thing I do is like what we do in banking. I build a model. I build a model for the company. I try and understand, where revenue comes from, all this stuff. I start getting involved in like building our board decks and everything, right? Like I'm our finance guy. I probably understand the like value of the company better than anyone else, right? Because this is my job, and like companies doing well. Like I'm interested in a job, and so I tell Keith Raboy was our CEO at the time, so I talked to Keith. I was like, yeah, I'm interested in a full time offer if you want to make me one. Like I don't need to go into VC, and so they made me an offer, and to be honest, like it wasn't a very good offer. At least what I felt at the time was not a very good offer. But
Yeah.
the way they presented the offer, they gave me two options. One with higher salary and less equity, and another one with less salary and more equity. And my my experience in finance had an instinct. I was like, well, I can calculate the implied value of the equity by looking at how much salary am I giving up, right? So I'm giving up $10,000 a year of salary for X dollars of equity. That implies a price per share of Y. And the implied price per share from the two offers that they gave me was probably like 1/10 of what I thought the equity was worth. So even though I didn't think the offer was very good, I went back to them and I was very direct. I told them as much. I was like, I don't think this offer is good enough, but like, would you be willing to go less salary and more equity? Like even more than, your low salary option. And they were like, sure. So they came back, they lowered the salary and they gave more equity and it was at the same rate. So I was like, they came back again. At this point, I would probably take the offer, but I go back to them again and I say, can you go even lower on the salary? And at this point, it escalates from HR, and now I'm having a conversation with Keith, and he's like, "Hey, Steve, like I don't want to keep going back and forth and writing these offers. Like, what do you want your salary to be?" And I said, "X salary is $1. I want my salary to be $1. How much equity will you give me?" Turns out there are minimum wage laws, so they couldn't pay me $1, but they paid me basically minimum wage, and I got an offer for an amount of equity that I think was very attractive. To answer your question though, like why did I think Square was better than other opportunities? That experience and getting that equity, it seemed like setting me up for a binary outcome on a bet I wanted to take.
How many employees did they have at the time?
I
Like
don't know.
roughly?
Yeah, so I think we had about 100 employees, but a lot of them were contractors because we were manually reviewing every transaction at the time.
Yeah.
I feel like
So
saying
they don't get equity basically. Like
no,
contractors
no,
don't
no,
get
no. They weren't even full time. They were like hourly. So we probably had like 50 people that were like full time, not hourly, like salaried.
yeah. So you like maxed out on the equity basically. You traded everything you could. Because I know people try to trade cash for equity when they take startup jobs sometimes, like especially if they have a lot of conviction, which is like you should have a lot of conviction if you're going to join a startup. Otherwise, you're like wasting your time, right? But I guess also you having the suits business that was throwing off cash and or I guess you sold it, but like I guess that allowed you to take a bigger risk or a bigger swing on the upside because you're not worried about like paying the bills or whatever, essentially.
Yeah, yeah, definitely. I would also say, like, I don't recommend people to take that kind of path. Like, I hear people all the time, they want to talk to me and ask advice on, how to value their startup equity or whatever. And I tell everyone, like, if you don't have access to the like preferred stock purchase agreement, you don't have access to like the corporate bylaws and the incorporation documents. If you don't have access to all the information you need to properly diligence the company the way you would in an M&A transaction, you don't have enough information to really value those shares, and you should be discounting them appropriately. I was in kind of a unique situation in that, like, I was the one doing all that for the company.
Yeah. Yeah, that's a great point. This is our disclaimer right now. Do not, go into financial ruins by making do not try this at home, kids.
And this is not financial advice.
Yeah, exactly. This is not financial advice. Do not come back and blame me or Steve when you do this and it doesn't work out. We did not tell you to do this, okay? But that was a great. It did make for a great story though, because obviously that worked out beautifully for you, with how Square ended up uh, trading and what they're trading at now. And um, I can only imagine. I don't even know what the value. I mean, like I said, you guys have just raised a $240 million valuation round. So I assume that was roughly the valuation you got at. Which anyway, that's freaking phenomenal. Huge congrats on that. And look, sometimes in life, like if you and I worked for a few different startups, and I think like if you the beauty of working for a startup is that you have if you pick the right ones, you have that type of upside, like even more than what you could get in finance, right? I feel like finance is like if you stay in finance, you stay on the banking PE path, you can do very well. You can make seven figures a year, maybe even eight figures a year if you just like stick with it long enough and make it all the way up to managing director or partner at a PE firm or whatever. And it's like the floor is a lot higher. You don't have to worry about like your equity being worth zero, but also like the upside is less as well compared to joining the right tech startup at the right time that ends up with like an amazing exit like Square did. So
Yeah. Selling your time doesn't scale, to put it simply.
right,
If
right,
you're in the business of selling your time for a salary, it just doesn't scale.
yeah, absolutely,
Or it scales linearly with time and experience.
yes, for sure. Okay, so I guess back to my other question then about how you build a finance and strategy team. So like, how did that come about? Because obviously, like by the time I had joined, it had turned into a pretty big team. I think we had at least, I don't know, what, a dozen people or so on the team by the time I joined a couple years later. But what were those early days like? And when it was just you and then eventually building that out, like, how did that come about?
Yeah, I feel like the raw, vulnerable truth that like people don't get to hear is I had no idea what I was doing. I really didn't. Like, I took this role and there was obvious work that needed to be done, so I started doing the work. But as we were growing and started to like organize as a team and, have like find responsibilities, we had to like hire people. I had never even heard of FP&A at the time. Like most companies had an FP&A team. So someone was telling me like, "Oh, you should name your team FP&A." I was like, "What's that?" Like, I've never heard of it. Like, what do they do? Oh, they do like budgeting and whatever. It's like, we don't do budgeting here. Like, but like budgeting is a waste of time, right? Like our budgeting is like, you want to go spend money on something, go ask Keith. I'll put it in the model. Yeah, it's so I really didn't know what I was doing. And I don't think that's a bad thing. I think like too many times like people think the solution is what other people have done. Like, let me go like study all these great companies and see what worked for them. And I like there's definitely value to that. I mean, there's like plenty of things that we got wrong in the early days too, but I generally think like if you're smart and you work hard, you do what makes sense, like you're generally going to get to a pretty good outcome. Like even in my professional experience after Square, like to this day, I think someone with experience doing a role is not as valuable as someone who's just smart and willing to work hard and figure it out.
Yeah. No, I think that's a really good point because as someone that's run a business for 8 years now, a lot of people just hire based on like experience or what school people went to or their GPA or, the stuff that you can see on paper, which is quite frankly, I think like a really lazy and terrible way to hire, because a lot of times the people that have those things aren't necessarily actually the best people for the job. And like, you didn't go to, an Ivy League school, for example, you went to Indiana University, and like that doesn't mean that, the people that did go to those schools ended up doing better than you did, right? But it's like, to your point, I think you have to hire for the right, it's more like hiring for the right people that have the right traits, the right makeup, the right work ethic. And but a lot of times it's harder to, I feel like it's harder to filter for that. It's easier to just look at like the things that you can quantify on paper or whatever, right?
Yeah, I think that's one of the things that made our team so special. By the way, your comment earlier about our team, I've it was amazing the caliber of people that we got all working together on one team. I don't know if you've done this, but I recently went back and people I'm not keeping up with everyone, but I was just like looking at LinkedIn, like the whole finance and strategy team. What are people up to? Well, one of them's the CFO of a firm. One of them's the CFO of DoorDash. One of them's the CFO of Fair, which is a private company, but 13 billion valuation. One of them started a company and sold it for like $1 or $2 billion. Uh, like it's actually kind of intimidating, like going through like our old team and seeing what people are up to. I feel like
I
I'm
know.
maybe not
Well,
accomplishing as much as I should have.
I have done that. I have done that actually. I do look up how everyone's doing every now and then. And yes, when I do that, a lot of times I feel like, man, what have I been doing? And like I mean that in like a good way, which is I don't, that saying, it's cliche, but it's like, if you find yourself in a room and you're like the smartest guy there and you're the most successful guy there, then you're like in the wrong room, right? And I just remember when I was on the Square FNS team, never felt like I was the smartest guy there. And in fact, I think I had a little bit of like imposter syndrome, because I was like, dude, like some of these guys are so much smarter than me. Like they say things that I don't even like think of, and I'm just like happy to be there and to be able to learn from them, and also,
Yeah, you earned your seat like anyone else. Actually, this is kind of where I was going with this. I think what made it special was it was just such a brutal meritocracy. Do you remember the interview process? I mean,
I do remember parts of, yeah.
first of all, I can tell you matter of factly that you didn't have any mistakes in your resume. And that significantly differentiates you from so many people, because otherwise
Yes.
I wouldn't have interviewed you.
Yeah. Yeah, no, and that came from, I also know, like, everyone on our team had already done banking and or something on the buy side already, which was like uncommon for most finance teams, right? Like you just most companies, I feel like, don't think about their finance org that way, where they feel like you have to have people with that type of, like, that level of, just pedigree and skill set and work ethic. And our team worked super hard, but also everyone came from that type of background, and the leaders of the team were quite frankly like super demanding, but we could handle it because we had that training that, like we talked about earlier. And we were probably like one of the hardest, if not the hardest working team at the entire company, I would say.
Yeah, totally.
Consistently in the office, the latest at night, still better than banking hours, but like, we worked a lot. And we had a lot of responsibilities, and we were involved in all the decisions, and it was amazing. And I don't think you always get to have that type of impact as a finance team member at a tech company, right? You don't always have a seat at the table when major decisions are being made. Not that we're like the final decision maker, but we get to have
It
like
felt that way
influence.
sometimes. Yeah,
Yeah.
it's funny. It's actually been really tough for me in my career afterwards, coming to the realization that that's not how finance works at most companies, right? Like at Square, I felt like finance was like the brain of the organization. Like, not to put anyone else down, like everyone plays their roles, but there wasn't a single important decision made at that company where a finance person wasn't involved, right? Like we would be in executive meetings reviewing a proposal. And if the numbers being presented weren't vetted by a finance person, stop the meeting. Like, we'll talk about this after your finance person goes and like builds a model and analyzes it. It was like, it truly felt like we had influence and impact in everything going on at the company.
Yeah, for sure. And so, I would encourage anyone, like, if you're leaving banking, leaving buy side, you're thinking about going in-house somewhere to work on the finance team, like make sure you look for a company where the finance team is not just some typical back office function, right? Like you're not going to feel fulfilled going from like banking or PE into a role like that. You just won't, right? You need to find a team that um has like, one A players that you can still learn from because you're coming from an environment where, like banking P, like everyone's smart. You're learning from the people around you. And sometimes you lose that, I feel like, in a corporate environment if you don't pick the right company and the right team. But also the other thing I will say too is like companies like the Squares and I think like Uber is similar now in terms of like, and even DoorDash, but like, like you said, the person running the DoorDash finance team came from Square FNS, right? But like
Came from Square, right?
and all of these Square FNS people that are now CFOs of these other companies, like you mentioned earlier, like I'm sure they took a lot of that Square FNS DNA and now they've kind of spread it out across different companies in Silicon Valley. But like you want to find a company and a team that has that type of DNA, I guess, is what I'm trying to say.
Yeah, totally. I think maybe like a quick, sorry, there was a little lag. I didn't mean to cut
No,
you
no
off.
worries. No,
I
no, no,
think
no
maybe
worries.
like a quick litmus test for people considering making this move is, I think people coming from an investment banking background are the highest caliber people in corporate finance. Like hands down, it's not even close. I think the litmus test is the person hiring you, like, do they recognize that? Are they super excited about like, oh my God, I'm going to get to hire an investment banking analyst? Like, I am so privileged to have such like an amazing rock star on my team. Like, if that's not their attitude, like if they, don't realize that you're special, then it's probably not the right DNA.
Right. Yeah, absolutely. That's a great point. I think that's a great way to do it. But I guess, the last point I'll say on this too is like, I think a lot of the companies that are really sought after, or, like the really hot, like the Ubers and the Squares and the Airbnbs like back in the day, like they also have the pick of the litter when it comes to like who they want to hire. Like there's so many people who want to work for those companies. And so when they're hiring, like Square didn't have to consider anyone who was not at that level because you guys could pick whoever you want, right? And that was just like where the bar was set at. And so I think part of the benefit of going through banking for a year or two first also is like on building up your credibility and your own credentials to make yourself a more attractive candidate to these really sought after companies so that they'll even consider you. And then the other thing too is like, I do think that starting my career in banking and PE first, when I was applying for tech jobs, I think most people out there, when they apply for tech jobs, they're not really super thoughtful about it, or they just like spray and pray. And it's like, whoever is going to give me a job first, then I'll just go there. Right. But that's like a terrible way to go about it, especially for tech, because so much of your compensation is tied up in the equity. And if you don't know how to like evaluate that business from like an investor's point of view and think about like, okay, their valuation is this today. To your point earlier, like, you're not going to have all the information that you would have in like an M&A process or whatever, but still like at a high level, you can do as much due diligence as you got. Like when I was interviewing with Square, just as part of the interview process to prepare for the FNS interview, which I knew was not going to be easy, I did as much research as I could on Square's business model. And then I thought critically about like, does this make sense? Do I think this is going to be a huge business? It's already worth $3 billion today. Like how much upside is there still left? Right. All of those things. And I just don't think that most people, if they haven't had the training and the education that you get from going through a job like banking or private equity, like you just don't know how to do that. You don't
Right.
know how
You're
to.
you're not equipped to evaluate that. Yeah.
Yeah. So like all those things combined in terms of like building your own credentials, learning how to think like investor, like I think they all help tremendously when it comes to like de-risking the decision of like, which startup you're gonna bet your career on. Because it's not even like when you buy a stock, you're supposed to do due diligence on the company, but that's just like you're investing with your money. And then if you lose the money, you can always make more money. But with joining a startup, you're not just spending money, you're spending your time. You're giving them like sometimes 4 or 5 years of your life. And that is time that you will never get back. Right? Like I have a friend that worked for a startup for 7 years, and then their equity ended up being worth nothing. Like that is like a terrible outcome,
Right.
right?
Right. I
So
mean,
anyway,
that's one of the biggest, when people ask me for help evaluating that stuff, one of the biggest things I tell people is like, if you're not professionally trained in evaluating this, like, don't just assume it's worth something. The thing that really like gets me is when people they're like an engineer or they work in a product role and they're like, the company is doing so well. I'm like, well, what makes you think that? And like, our users love our product. Our product is great. Like everything they're exposed to and they see, they think it's like it's going well. And I'm like, well, that might all be true, but what makes you think that justifies a higher valuation than what the stock was already worth today? Right? Like, how are you evaluating all these things that you think are great about your company relative to its price? And most people for most people, like it kind of clicks. Okay, I'm actually not professionally trained in finance. Like it's more complicated than just like, am I working at a good company? You can be working at a good company and the stock is a bad investment.
yeah,
And a
for
lot of
sure.
times
Because
that's
they're
the
already
case.
overvalued.
Yeah.
Yeah. Especially nowadays. Especially nowadays, right? Like I feel like a lot of these, not to go too far off topic, I feel like a lot of the AI companies these days are like getting pretty bubbly, you know? And so like you join the wrong one, they get a couple down rounds, like your equity is going to be underwater, right?
Yeah,
Hopefully not.
totally. You go join OpenAI, you're like, hey, like everyone loves our product. We're getting more users. We're changing the world. Everything's great. It's like, well, yeah, but like, the company's valued at, I don't even know, 150 billion or something. It's like, if you're not changing the world, you're losing money.
Yeah, and that's a great example. It's like that is objectively a great company. Like they're doing really well, but they're
Right.
also like
Great company,
burning
great
through
product. I use ChatGPT. I like it better than some of
every
the
day.
others.
Yeah.
I wouldn't buy their
But they're
stock.
burning. Yeah, exactly. I've had opportunities to invest in their private rounds and whatever. I'm just like the valuation has gotten so crazy. Um, and look,
And
not
more
saying they won't
importantly,
be.
like we don't have access to the information we'd need for me to feel comfortable buying the stock.
Yeah, yeah, and I'm not saying they won't live up. I'm not saying they won't live up to their valuation one day, but it's just that like they are burning a ton of cash right now. Like all the models that they're training, the data centers they have to invest in, and who knows, they could or they could not live up to those values. Look, they got a great CFO, as we know, and so I'm sure I wouldn't bet against them
Sarah
either. But
Fryer
I'm just
from Square.
yeah, who exactly for people who don't know the
For
old
people who don't
CFO,
know, Sarah Fryer was our CFO at Square, now CFO at
right?
Open.
And she's great. She's amazing. But like anyway, to your point, like a great company does not always mean it's priced right, and you have to be able to evaluate both
While, while
in order
we're
to get a
Yeah, while we're talking about equity compensation, something that I think is kind of interesting, I think you'll find that this way of thinking about it interesting, but equity comp at startups, for whatever reason, has standardized around options that vest over 4 years, right? That's your experience, right?
right.
Do you know why that's a standard? Like,
I
why
don't
4 years? I don't
I don't
either.
know the yeah.
I don't.
Good
I don't
question.
actually. Yeah, I don't actually know why it's a standard. A thought that I've had more than once is, it's sort of weird that a company gives you equity that vests over 4 years. They're promising to pay you a certain amount of equity every year for 4 years, but the company doesn't know how much that equity is going to be worth. A lot of people try valuing this like option as stock, but it's not stock. It's actually an option. And if you get into option valuation, one of the biggest contributors to higher option value is uncertainty. Actually, it's risk, right? Like the more variance in the price of the option, in the price of the underlying security, the more valuable the option is. And it's always struck me as kind of odd that like you could go join a startup, get a bunch of equity, and if within a year, if you're able to evaluate this, you'll have a pretty good idea of if the startup's going somewhere or not. If it's not, you just quit. What did you lose? I mean, you're probably getting, less than market salary. So you lost 30% of your salary. Okay, go do it again. Just keep doing it again until you find a hit. And when you find a hit, the value, like, because it's so binary, the value of that equity will more than make up for the 30% of salary or whatever it is that, you're getting paid below market, right? Like when a startup hits, that equity ends up being worth, 10 times what you would have made in annual cash compensation or something like that.
Yeah. Yeah. Although I would say like, I don't know, that's like easier said than done though, right? Like like what percentage of people who have worked in Silicon Valley do you feel like have experienced like a material exit that you would qualify as I don't know, like life changing. I don't want to say like it's not like I don't want to say like oh retirement money, but like at least move the needle, right? Like I feel like it's not everyone,
Well,
right?
just look at our FNS team, right? It's like true for almost everyone we've worked with.
But again, I think the people on our FNS team, I don't consider them to be like the average of the population. Like they are all like really highly trained in finance and investing and how to evaluate opportunities. They have the credentials. They're some of the best candidates. They have certain things that I feel like set them up for that success. Whereas like I feel like a lot of people that don't have that, like I said earlier, they just spray and pray, and it's like buying lottery tickets, and that usually like more startups fail than succeed by a wide margin, right? So if you're just doing spray and pray, like statistically, the odds are not in your favor, I feel
Yeah.
like.
Yeah, totally. Well, I mean, this gets back to the point we were discussing earlier, which is, valuing an option in a private company is a very nuanced skill that not very many people have. And it also requires you to have access to data, right? Like if you're not working in the finance department, you probably don't have access to the data you need to really evaluate that. So I think the people who are capable of executing on the strategy I talked about are, they're like our colleagues that have done very well with it. They haven't had to like have very many at bats because they find good ones quickly.
For sure. For sure. Okay.
Yeah, that
So
sorry. Sorry, I'll just say the saddest thing was like some people at Square even before your time, but there's one I remember in particular was like 7 days away from hitting his 1 year cliff, and
mm,
he was taking another job. We were like having a going away party for him, and I asked him about it. I was like, "You don't want to like stay one more week just to like get your like 1 year cliff of equity?" And he was like, "No, like I don't think it's going to be worth anything." And this guy was early enough that I don't know. Anyway, I like, those are the stories too, that it's not just working somewhere and having the equity be worth zero. You get people that make the wrong decision the other way too, where like they were early at Facebook or whatever, and like they didn't recognize you know, the value that they were sitting on. And anyway,
yeah. I mean, leaving a week early before your cliff, that is just unfathomable. To me, that's like the risk reward on that decision is so poor. Anyway, I don't know who this is, but so I'm not gonna judge them too much. But I guess moving on, you spent like 4 years at Square, right? It was a very long time, and then you left, and then you started your own family office called AKO Firm, right? And talk a little bit about that. Like, what is a family office? First of all, what do you guys invest in? And then I saw also that you guys have like annualized returns over like 20% over a decade long period or something like that, which is really impressive, by the way. So what is your like investing philosophy, I guess? And also like how are you able to have the type of success that you've had over the last 10 plus years?
Yeah, totally. Family office is a fancy way of saying like I retired and stopped working. It's hard to tell people that in conversations, especially when you're, 28, 29 years old. People are like, "Oh, what do you do?" "I'm retired." Let me tell you from personal experience, doesn't lead to a good conversation. You get a lot of weird responses and feels awkward. But yeah, so the thing is too, when you stop working for someone else, it's not like you stop working, right? Like we talk about working really hard as an investment banker. That skill is not about like giving up valuable time to like trade. That skill is about like being focused and like committed to things that you want to get done. And when you stop working for a salary, like there's still plenty of things that interest you that you want to do. I've always been interested in entrepreneurship, so I've got involved in a number of different startups as an advisor, investor, board member. There have been, friends that have gone through M&A transactions, and I'm working harder on their M&A deal than any of their employees, right? I'm like working 40, 50 hours a week, helping them negotiate legal documents and things like that. So that's what I was doing, during the time that I was working on this fund. I had a couple friends from Square that, I'm like the neighborhood finance guy. They're like, Steve, will you like help me with my money? And my I wouldn't even call it a pitch. My response to that was, look, like I'm not going to put a lot of effort into this. I manage my own money. Like I have a strategy. I could talk to you about it if you want, but I have a strategy for how I manage my personal portfolio. I will put all of my liquid wealth and some illiquid wealth, illiquid investment. I'll put pretty much all my wealth that I can into this fund. And if you want to invest your money into this fund too, you can be along for the ride. I don't do quarterly reports. I don't do investor relations or anything like that. Like, I have a fund administrator that does the accounting and you'll get a statement and stuff. But it's really just, it's my money, and anyone who wants to be along for the ride, they can be.
Yeah.
That's the fund. The 20%.
What do you invest in? What do you invest in? Like what kind of investments?
Yeah. So my general philosophy is I think it's difficult to have an edge in the public markets, right? Like after working in investment banking, especially seeing some of our friends that went into hedge funds, the tools that they have access to, the resources they have at their disposal, the amount of time and effort they're putting into evaluating these stocks, you can't compete with that. Right. Like, a lot of these like bigger funds, they can call up the CEO on the phone and, even if the CEO's not supposed to disclose material non-public information, they can answer questions and educate you in a way that, like that kind of access is just really meaningful. And not everyone is playing fair too. I think there's plenty of like illegal insider trading activity that goes on too. So my general philosophy is, the like fire mentality of like just buy an index fund, set it and forget it. I think where I differ from that is I think long-term macro trends, the impact of the trend is much bigger than anything any one hedge fund can respond to, right? Like if you think the Fed is going to lower interest rates, the amount of wealth that changes hand on that decision, like if a hedge fund knew that the Fed was going to lower interest rates, no one hedge fund could completely squeeze all the alpha out of that trade, right? It's impossible. Like no one has that much capital. And so I do make like macro decisions. I will at times move portfolio from like a public index fund into right now I have some bonds and things like that. And anyway, so that's the public portion of the portfolio. The private portion, I think differently. Private opportunities, like my own personal deal flow is unique. It's an edge that I have over public market competitors, right? Like I have opportunities to invest in deals that the first question, whenever anyone asks me like, hey, should I invest in this thing? The first question I always ask is, why do you have that opportunity, right? Like, does someone need your money, or like, are they your friend that you've known for 20 years? You guys were roommates in college. They're a fucking rock star. You've gone on family trips every year for the last 10 years, and they're starting a company and you're like privileged to like have the opportunity to invest. Like that's the answer I want to hear, right? And I do think that there are private market opportunities where, again, I actually have the skills and the acumen to evaluate these opportunities. And I do sometimes get opportunities that I think will return above market. So I probably have like 30 or 40% of my portfolio in private investments right now.
Yeah. I guess maybe a better question would be for someone who's listening to this and they're like, I want to one day also get that type of similar access to these, off market or private opportunities. How do they get there? Is that just like, it's just more about who you know? It's like, you have to build a really incredible network of really successful people, and then they're going to have access to those opportunities. Or like is from a practical standpoint, like, if that is your goal, like how do you do that? Or you just need to make a lot of money, and then like the more money you make, the more people will come to you with all sorts of opportunities? Or like what
Well, I
what do
mean,
you do?
making money definitely helps, but that doesn't necessarily attract good opportunities, right? Like people who are coming to
I
you
agree.
because they know you have money. There's kind of goes both ways. Like I have friends that know me as someone they can come to when they have like a special situation. And so like, being known as that guy, like can bring good deals, but a lot of times like having everyone know that you're wealthy isn't necessarily going to attract the best investments. But to answer your question, one thesis that I've had is I think there is a pretty specific inflection point in people's lives where they have an abundance of these opportunities. It's probably like, to put an age range to it, it's probably like 30 to 40. But the people that you're lifelong friends with from these communities that you're a part of, you've follow over the years, it's pretty easy to know who the winners are, right? Like you think back to like your buddies in college, like you know who the goofs were, you know who the serious people were, and you look at them through 10 years of their career, right? Like you look at what you thought about someone, and then like they go and like they have a successful career, they do stuff, like you see how they make decisions, you see personal decisions, like who do they marry, like do they decide to have kids, which city do they, you get all this data, and it's just pretty obvious like who in your network the winners are. And this inflection point happens when you're equipped with the knowledge of the winners are obvious to me, but we're at a point in our lives where my money is still valuable to them, right? Like all these people, by the time they're 40, like they're not coming to me asking for money, right? There's no opportunity to invest, like maybe as like a token favor, but they're looking for like strategic, and they're so successful, they have an abundance of access to capital. But when people are like around age 30 and they're looking to like reinvent themselves from like a finance career or something, I feel like that's like the special opportunity where you can sort of be confident in underwriting the investment while at the same time like having the opportunity.
Cool. So obviously, you continue to manage your family office because that's just manage your own wealth. But in addition to that, over the last several years, you've also been working as a CFO for a early stage startup called Outgo. And I know you guys also recently exited the business as well, which you were telling me about that the last time we met up. And so huge congrats on that. But talk to us about the experience of exiting that business, especially from like the CFO's point of view, because you were obviously deeply involved in that and you played a huge role in making that a successful transaction. And I know you had some pretty fascinating stories that came out of that. So to the extent, like, whatever you can share or talk about, like, I would love for our audience to be able to hear some of that.
Yeah, this deal was my magnum opus, literally my best work. Yeah, it's fun working on these things when you have the benefit of experience and knowledge and several iterations doing them. I probably can't go into too much detail, because it's a private transaction bound by confidentiality and stuff like that. But I can talk a little like high level about the experience. I think first of all, like probably the reason my reaction is like, this is my magnum opus is like, this was very much a story of, it wasn't necessarily going to be a good outcome. Like we were talking before about like selling your company generally isn't good. This was definitely setting it up to be that way. The acquirer that ended up acquiring us does have a very strong strategic rationale for acquiring our business. So they do have an ability to pay perhaps more than what we think the company. Let me see how I say that. Again, as an
There's a lot of
entrepreneur,
synergies. There's
there's
a
a
lot of
lot of
synergy.
synergies. As an entrepreneur, I think it's always a sad thing to like sell your company, right? Like I much rather would have continued to operate independently and compete in the market, on our own. The market that we're in is a pretty tough market, though. We do a form of lending called factoring, specifically for trucking companies. So when a truck driver delivers a load, they typically don't get paid for 30 days. A lot of truck drivers in the US are owner operators. They're single person shops. And, they can't just float 30 days of fuel and all the other expenses to operate their business. In fact, usually when people get into this business, they take out a loan to buy the truck. They take out debt to buy the truck. They start doing work. They do their first load. They have to pay for their own gas, and then they don't get paid for 30 days. So what we do is we buy the invoice from them at a discount. And this really provides two services for them. One is it's a type of secured financing. Because our credit to them is secured by the invoice, we're able to offer more attractive rates than, say a credit card or something like that. Two is the truckers in this industry, because of the internet and stuff, the number of counterparties that they work with has just exploded over the years, right? It used to be that, you're hauling from Florida to Alabama, you call up, one of five brokers, say, what load do you have me that gets me, closest to Alabama? Now they go onto the internet and they search for like the optimal load that gets them to exactly where they want to go and pays the highest rate to do it. And so they're working with all of these counterparties and they don't really have a good accounts receivable process. When you're getting paid by 20 different people, keeping track of who's paid you, following up with them. So we do that. We handle getting paid on the invoice. Anyway, so the service is really popular. I think probably 90% of truckers in the US use factoring. Over 50% of all loads are factored by volume. So it's a very popular business. Our whole idea was to use software to automate the AR operations of factoring. And specifically in trucking, there's a lot of like documentation, proper work. So we said, hey, we can build like a purpose-built solution specifically for this that does it really well. And if you look at our competitors, they spend probably 40% of revenue on operations labor. So like there's an army of human accountants or people that get on the phone, they keep track of, this invoice has been paid, like calling up the broker, why haven't you paid me? So we automate all of that. We automate sending out emails. We have LLMs that look at their responses and parse it, update the data in our database. And, it's this, really great system. The problem is that we still need capital to run our business. And so even though our product achieved our product goals, like we've reduced those human operational costs from 40% of revenue to maybe 15% of revenue, something like that. However, the big competitors in this industry are all banks, and their cost of capital is SOFR, right? They can borrow from other banks. Even the non-bank players in this space, the really large ones, I've come to learn that they have access to credit at very attractive terms, like SOFR plus 70 bips. Our initial credit facility was closer to 20%. I won't say exactly what our rate was, but 15 to 20%. And so even though we have this structural cost advantage from our software, our cost of capital is just extraordinarily high. And at the size that we are and being a tech startup, financing for credit and lending tech startups has kind of fallen out of favor. As we perform and do better, we're getting the cost of capital down. But at the rate that our cost of capital would decline as we scaled, we'd continue to need more equity capital to fund the difference. Anyway, so you're kind of seeing the picture here of we build a great product. As a standalone business, we have a lot of challenges. And even if we go and get the capital, we're going to be diluted a ton along the way. Investors, equity investors understand that the debt capital is a risk. It's not like you're funding a SaaS software product that has, high margins. Anyway, so that kind of comes to this deal where, for DAT, they're the largest load board in the United States. So they're where truckers go to like find their loads. It's a very natural product. Factoring is a very natural product for them to have. And in fact, they had a referral agreement. The two prior factoring companies that they had a referral agreement with became the number 2 and number 3 players in the space almost entirely through this referral agreement. So most truckers, when they're getting into the business, they go find work at DAT. They realize they need a factoring company. They use DAT's preferred factoring partner. So DAT is finally like, hey, we're going to get into the factoring business. Outgo has this unique tech forward solution. This is great. So yeah, anyways, it ended up being a pretty good deal for everyone involved. The part that I'm so proud of, and I don't think I can really go into the details here, but there is a lot of legal structure that we were able to negotiate that gave us some pretty significant tax advantages. And it went from like the after-tax deal consideration pretty much doubled as a result of like these creative solutions. And, I'm taking credit for that.
It is, I mean, look, and as a CFO, a lot of the responsibility for, negotiating terms fell on you, right? And so to be able to double the outcome for all of your co-founders, I think that's an amazing outcome and something you should be proud of. which you are. And so then like, are you guys are acquired by this larger player, and then you and the co-founding team just went with the business and now you guys work for the acquirer? Is that kind of how that works? And then like, are you just like, we talked earlier about like, if you get bought and then you get paid like in, the buyer shares. I guess in this case, because it's so synergistic and it sounds like you have a great product, they have great distribution, and you combine that and they can probably just like, massively increase your sales basically. So like this is one of the instances where it would be actually a good idea to maybe take equity in a new business, right? I have to think.
Yeah, totally. Well, so DAT is owned by Roper Technologies, which is it's like a $40 billion publicly traded company. So all of our equity is in, a diversified public holding company. I would love to take stock in DAT specifically if I could, but that's not an option. But yeah, it's so funny. I mean, these like for me, my role in this M&A process was very intense. It was crazy amount of work. I'd like to thank my wife for supporting me during it. I worked every night, every weekend for, many weeks. It was such a sprint. And by the end, I was like pretty low on sleep. Like it was kind of like banking again, to be honest. And so I actually didn't know that we were going to close. The morning of the closing day, we have a 7 a.m. call with the lawyers. And I've pulled an all-nighter to like do like last minute things. And there were like a few outstanding items that we thought might hold it up. But we have this call with the lawyers and they're like, it's okay. We're good to close, release the signatures. And so I'm like exhausted. I'm like, holy shit, we did it. We're like, it takes like an hour for people to show up. People get in the office. We pop the champagne, that whole thing. And I'm thinking, I'm going to go home and sleep. This is a Friday, by the way. I'm thinking I'm going to go home, or it's a Thursday. I'm going to go home. I'm going to take Friday off and I'm going to sleep the whole weekend. That's my plan. Like, I've worked so hard. I deserve a day off. So 12 p.m., we announced the acquisition. Our lead volume to our sales team was 50 times our previous peak, 50.
Wow.
And it immediately became like an all hands on deck 5-alarm fire. We had to scale our sales team from 2 full-time AEs to 12 in the next 2 weeks.
What a great problem to have, honestly.
Yeah, it was great. It would have been a lot of fun, but I would have liked a short break in between.
Not right at that moment. Exactly.
Yeah.
That's funny. Okay. I want to end on like one final question, which I always ask in these interviews. So, especially for someone like you founded multiple businesses, you've helped scale, really high growth startups to billions of dollars. You've launched all these different products across different industries. You've worked as a CTO, you've worked as a CFO, you sold multiple businesses, you've done a lot. And so I'm sure you learned just so much along the way by going through all of those experiences. And so knowing what you know now, what would you tell your 18-year-old self today? Like, because I think most of our audience, they're kind of in that college age range, right? And they're just starting to think about what they want to do for their career. And in a way, it's like, there's so many possibilities. And then in another way, because there's so many possibilities, like people don't really know what to do or what they want to do or what is the right path. Or so like, if you think through, like kind of put yourself back in their shoes or back when you were in college and you didn't know all the things you knew now, like what's something that the wiser Steve would now tell the younger Steve, I guess?
Yeah, that's a great question. I think the most valuable thing you can do at a young age is cultivate a thirst for knowledge. People who pursue learning with a passion, knowledge compounds. Everyone understands like compounding interest. If you're in finance, you've like done the model that you can make minimum wage and make $10 million over your life if you compound at 15, 20%. I think the same concept applies to knowledge. Like when I look at people that like I'm excited to work with and people that are successful in their careers. If you're just thinking about investment banking, like that's 1 to 2 years out of college. Like that is just such a small amount of time. Investment banking is not the end goal, right? The difference between the investment bankers that treated investment banking like an opportunity to learn and really wanted to get everything out of it, by the time they left investment banking, they're just so completely differentiated. Sam, my comment earlier about like you deserving to be at Square, I don't know if you remember, but I gave a technical modeling interview, and I've probably given this interview 500. The interview is designed to be challenging enough that almost no one completes it. Like I want to understand where, how far people get and where they fail. And there are, there are very few people that, performed as well as you did in that exam. And like, those are the people we hired. And I think when you take that kind of thirst for knowledge and you compound it over not 2 years, not 4 years, but like 10 years, 20 years, the difference between the people who always want to learn, always want to improve, and the people who sort of like accept, the status quo or get complacent, like the difference grows as time goes on, right? Like the difference between an investment banker and a consultant, or, I don't know, that was a trope back in our day, but like that's not as big as the difference between, someone who's spent 10 to 20 years. Like, some of my friends are business owners, and like they just have such a passion, such a thirst for knowledge, and they are always improving. And what they are capable of doing is so impressive. Anyway, so that's my advice. Cultivate a thirst for knowledge. It compounds over time. If you work hard and you always try and improve over time, you will differentiate yourself and you'll be in that top 5%,
That's such
whether
good
you get the
advice.
investment banking job or not.
No, that's such good advice because I think back to, when I was a student coming up, I feel like when I was a student, I actually didn't really approach learning the right way. It was all just about like academic achievement, getting good grades so that I can go to a good school, so that I can get a good job. I wasn't really like learning because I enjoy learning. If anything, when you do it for those reasons, learning and school is more like a chore. That's just like this thing I had to do, right? To get straight A's or whatever. And to your point, like now that I'm a business owner, I have been for the last 8 years. I think the last 8 years, I've learned to just really enjoy learning for the sake of learning because and I don't really feel like I truly became that way until I became a business owner. Because when you become a business owner, there's just so many things that you have to figure out constantly, and a lot of times these are things that you have never done before, you don't know how to do it, or, and I'm sure you had this type of feeling many, many times throughout your entrepreneurial career, or even when you were at Square and starting the financial strategy team, like you said earlier, it's like you had no idea what you were doing, and like those are the times where you're forced to like learn something new, and now like I'm constantly like, I spend a lot of time on YouTube, but it's not like how most people use YouTube where you're just like doom scrolling and whatever. It's like I'm a lot of time using YouTube to learn stuff because there's actually a lot of really good information on YouTube if you follow the right people and the right channels, and just so many people sharing their knowledge and expertise, and it's all free. Like there's like literally no reason today, if you're someone who has a thirst for learning, that you shouldn't be able to learn whatever it is that you want to learn. All the information is out there. And like as a business owner, it's literally a necessity because as I grow the business and I get to a new revenue level, I describe it like a video game. It's like, when I first started Wall Street Mastermind, in the beginning, like the goals are modest, right? It's like, oh, I'll be so happy if I can make like $10,000 a month in this business. And then you're like, okay, now I'll be so happy if I can make $25,000 a month. And then you hit that, it's like, now it's 50, now it's 100, now it's 200, now, and like you keep moving the goalposts. But every level you get to, there's like a new boss, and then you get stuck on that boss, and then you die repeatedly because you don't know how to solve like the new constraint that has popped up in your business at that time. And then you figure it out after dying multiple times, and then you get to the new level, and then you plateau there for a while again until you solve that constraint. And it's just like every new level requires me to learn something new. And then so like when I think of it as like I'm playing like a real life video game, it actually becomes fun and enjoyable. And that's how I've been able to just like fall in love with learning. And that's like learning how to learn is like probably the most valuable skill you can develop because like you said, like just everything you do just compounds over time, right? And you become like a more valuable person because you can contribute more to society,
Yeah. Yeah, I mean, I guess this is obvious, but the limiting factor to what you can do with your business is you. And I think the thing that I'd challenge younger people to think about is even if you're in investment banking and you're, a slave to the machine, it's still true, right? Like like owning your own business isn't what like unlocks you, right? Like in investment banking, you could be learning, how do these people, these bankers that you work for, how do they convince a client to trust them? Like that is a valuable thing you could learn. You could, one of the most valuable things I learned in investment banking was when we were doing a synergies analysis. And my job was to read every executive contract at this company and determine who we could fire and how much it would cost us. I know that sounds really sad, but I learned so much about executive compensation and like all the different like features that were structured in executive compensation. And now I use that knowledge to negotiate my own compensation, right? It's there, whether you have a job and a career or whether you're an entrepreneur, it's still true that the limiting factor to you achieving all the things that you want to achieve is you.
Yes, absolutely. Yeah. Your business is going to go as far as you're able to take it. And if you don't know how to do something, or you have a blind spot or whatever, then that is the limiting factor. That is the constraint in business. So it's like, if I know how to build $100 million business, then my business will already be $100 million, right? And then like, if I know how to build $1 billion, like I don't, that's why it's not at $1 billion. And so like literally every day, I think like, there's this guy online that I follow that I've learned a ton of stuff from, but he says like, people don't think about it this way, but like knowledge debt, like every day that you don't learn the things that you need to learn is actually costing you, a certain amount of like money. Like every day I don't know how to grow my business to $100 million. Like that's the opportunity cost that I'm leaving on the table. And so when you think about it that way, it's like, there's nothing more valuable that you can do than to just like get really good at learning.
Yeah. Who's the person you're talking about that you like listening to?
His name is Alex Hormozy. You might have seen
Yeah,
him too.
of course.
Yeah. Yeah.
Kind of hard to miss his content. It's
Yeah.
funny. YouTube suggested me something from him back when he had like 30,000 followers, some much smaller number of followers. And it was like really attractive and engaging. Like he was talking about tax structuring at a very detailed level, right? I've never found content where someone actually knowledgeable about this stuff was like willing to share it. And it's been so fascinating seeing his journey of like he is upfront in telling you like, hey, I am going to try and increase my following by doing this and this and this. And then he does it. And now he's, I think he's probably like one of the biggest like business content producers out there, acquisition.com.
He definitely is. I mean, he just launched his third book and they sold like $105 million worth of books in like 3 or 4 days, which is insane. But that did not happen overnight, right? That like he built up his brand for the last several years, and everything he's done has been very like deliberate and calculated in terms of building up to this, right? And so there's like people just see like the overnight success, but actually there's like so much.
He works so hard. He works harder than anyone. Yeah.
And to his credit, like most people that have had the level of success that he's had would not work that hard, because you don't have to. You know what I'm saying? Right. But I think he actually like likes the work.
Yeah, it's exactly. Fun. There's a really cool interview they did with Alex Hormozy and his wife. I forget her name, but
Layla. Yeah.
They were talking about his birthday. She was trying to think of something, or he said that she got him like one of his favorite birthday presents ever. And they were like, what is it? And what she got him was, do you know the story?
Oh, I do. But for our audience, you can tell it.
Yeah. So she got him like, I think it was like an hour with Grant Cardone, who's like a very successful content, someone he looks up to and could learn a lot from in his own business pursuits. And there were two things that were really interesting to me about this story. One is that like this like really valuable, thoughtful gift was the gift of knowledge, really. It was access to someone who has knowledge that you want and an opportunity to pick their brain and learn from them. And the other thing that was really cool about this story was hearing how she got the gift, because she like sent them an email or talked to someone and they were like, no, like this guy's not going to get on the phone with you. And she's like, you don't understand. I will pay like whatever his time is worth. I will pay it. I, the thing that I thought was interesting was how she was like so persistent in not taking no for an answer and like continuing to escalate. And I think they ended up spending like, $100,000 or something like that for like, it seemed like kind of a lot of money, but I just thought it was so cool that they valued that so much.
Yeah, and the thing is, like, at their level, right? Like their net worth probably, I don't know, is if not nine figures, definitely high eight figures, but probably nine figures, I would guess at this point. They have all the materialistic things that they could ever possibly want. And I've met Alex in person actually. He's like exactly how yeah, but I mean I had to pay to meet him too, right? Like so it's of money to spend time with him and asking questions about how to grow my business. And that's like me investing in knowledge, right?
Oh,
But the point I
I
was gonna
love
say,
that. That's
but
brilliant.
but but the point is like, and I didn't pay the hourly rate I paid him was not as much as what Layla paid Grant. But just to be clear, okay. But my point is like for someone like Alex, like it's really hard for his wife to be able to get him a gift that is something that he doesn't already have or can't already buy for himself. Like and he's not a materialistic person, so he just walks around a wife beater all the time, right? He wears like a white tank top. Like he doesn't wear expensive clothes. He doesn't do any of that. But also, like that's
Yeah. It's knowledge, right?
most people would think like you paid $100K to talk to Grant for an hour, but to someone at his level playing the game that he's playing, even just one thing that he learns from that hour, if he goes and applies it to his business, will make him way more than the $100K that he spent, which is exactly what happened, right? Like you said you followed him when he was at 30,000 followers. His main takeaway from that meeting with Grant was just like how much more content he needs to put out compared to what Grant was doing. And then you fast forward like a couple of years and now he has like, millions and millions of followers across all the social media platforms. Like that was what clicked for him. And
Yeah.
then how much is that? And then that led to him doing this book launch, selling $105 million in 3 days or whatever. And it's like, so what's 100K? Right?
Yeah.
And
Yeah.
is
It might have been
so
a
anyway,
great return on investment.
yeah. Anyway, I think like to go back to your original point, which is just that like having that thirst for learning and continuing to like invest in yourself. And by the way, you don't have to pay to learn. Like I said, a lot of this information is free, and you can learn a lot of stuff just for like if you don't have money, you can still learn, right? But also like if you do have money, sometimes like a lot of times it makes sense to invest in getting more knowledge because that knowledge could, as long as that knowledge that you will gain is worth a lot more than what you're investing, then that's a good investment. And that knowledge is like something that stays with you forever and you can never be taken away from you. Right. So anyway, man, this has been really fun. I've on here for 2.5 hours, I think. Um, so thank you for being so generous with your time and just walking us through pretty much every single thing you've done in your career, and you've done a lot. And so I'm sure our audience learned a ton from all the stories and all the insights that you shared. On a more personal level, I think it's been a privilege to be able to just call you a mentor, going back to our days of Square to then later, I would say becoming friends when I lived in Seattle for a couple years. So yeah, man, I just appreciate you and thank you for, taking so much time out of your day. I'm sure you're super busy and you have kids just like I do. And so, yeah, man, thank you for coming on here.
Thanks, Sam. I super appreciate you too. It's been a privilege the whole journey working together, knowing you, and this was really special. I'm glad we got to do this. So thanks for making it happen.
Absolutely, man. All right, guys, we're going to wrap it up. Hopefully, you guys enjoyed this, and we'll be back with more interesting people and stories for you guys in the near future. But until next time, all right.
All right.